Hey option traders, for today's trade we're looking at a neutral option play known as an iron condor in banker JP Morgan, which is set to report earnings on Friday before the opening bell. So shares have been drifting slightly higher over the past week as shares hold support at their 200-day moving average. The banking crisis knocked shares lower in strong volume in early March, but this has allowed the stock to set up a new flat base with a 144.44 buy point. Currently, shares remained around 11% below that entry. Compared to other major banks and most regional banks, JP Morgan was relatively unhindered by the banking crisis. Earnings and sales growth has accelerated in recent quarters with a year-over-year EPS increase of 24% in the most recent quarter. Meanwhile, sales jumped a powerful 55%. Analysts expect the company to show EPS growth of 2% for 2023, followed by growth of 3% for 2024. As for the upcoming quarter, analysts expect earnings of $3.36 per share on revenue of $35.7 billion. So how do we take this upcoming earnings event and construct an option trade around it? Well, the first thing to note is that JP Morgan has stayed within the expected range following 4 of the last 6 earnings announcements. So for Friday's earnings report, JP Morgan is anticipated to stay in a 4.2% range up or down. So traders who think the stock will not move too much following this report could look at an iron condor trade. As a reminder, an iron condor is a combination of a bull put spread and a bear call spread. The idea with the trade is to profit from time decay while expecting that the stock will not move too much in either direction. An iron condor is a risk-defined strategy, which means you know your max loss potential ahead of time and it's not unlimited. This is a great way to get exposure to a stock without taking directional risk. So let's take a look at my trading platform and set up a trade. We'll be using the April 14th expiration for all legs of this trade. For the bull put spread, we could sell the 122 put and buy the 117 put. Then the bear call spread could be placed by selling the 133 call and buying the 138 call. In total, this iron condor will generate around $1.10 per contract or $110 of premium. The profit zone ranges between 120.90 and 134.10. This can be calculated by taking the short strikes and adding or subtracting the premium received. As both spreads are $5 wide, the maximum risk in the trade is $390. If we take the premium divided by the maximum risk, this iron condor trade has the potential to return around 28.2%. If price action stabilizes in the stock, then this iron condor will pay off. But if JP Morgan makes a bigger than expected move, the trade will suffer losses. Remember that trades held over earnings allow very little room for adjusting, so they can be pretty much hit or miss. Although we know past performance doesn't guarantee future performance, these patterns definitely help us weigh in on making our decision. As always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment. Check out the new Options Trader app from IBD for more digestible options education and tons of great trade ideas. And be sure to join us for our regular options content where we break down a new trade idea every day.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.